When an organization is seeking cost-effective or flexible asset management solutions, this lease financing is a very valuable tool for them. So there are a number of benefits that are, actually vital in order to consider the long-term efforts and ensure that the terms fit the company's financial plan. So let us try to understand in detail what is lease financing. So lease financing is a type of financial arrangement in which a lessor lends an asset to a lessee. Okay, lessor is giving or is lending the asset or machinery to the lessee for use in return for regular payments. Okay, so the lessor does not transfer any ownership of the asset. That means the owner does not change. The owner is still that person. We are only allowing the company to use the asset. So they don't become an owner. They are just a lessee. So there is no transfer of ownership in the lease finance. With the help of leasing, companies can acquire necessary machinery, equipment, or real estate without paying the hefty upfront cost of buying the assets outright, right? So this lease financing, it offers companies an adaptable and affordable means of utilizing essential assets without the cost associated with ownership, okay? So there are several types of lease financing available in India, depending on the asset and the business needs, right? One of the most common type of lease is called as the operating lease, right? Operating lease is a short-term lease, okay? And this lease allows the lessee to use the asset without taking on the benefits and liabilities of the ownership, okay? So the lessor is still in charge of the asset ownership, maintenance, and associated risks also. So any maintenance and everything has to be taken care of by the lessor only. So these operating leases, they are appropriate for assets that need to be maintained regularly, that need to be upgraded very frequently, or they are anticipated to have a very limited useful life. That means, maybe just for 2 years, 3 years, the machine would be used. After that, the machine would not be used. It's for such kind of machines, operating lease is very, very appropriate. Next, coming to capital lease. Capital lease is also referred to as financial lease. Okay, these are long-term agreements, right? Operating lease was a short-term agreement, short-term lease, whereas capital lease or finance lease is a long-term lease in which the lessee bears most of the risks and benefits associated with the ownership. So maintenance and any associated risks, all that are to be borne by the lessee and not the lessor. Okay, and these financial leases usually correspond to the asset's useful life. So for the entire useful life of the asset, the financial lease is usually taken, and they are mostly non-cancelable. Non-cancelable meaning that the lessee is obligated to make the lease payments for the entire duration of the agreement. And lessee can buy the asset at a much discounted price at the end of the lease. From the now the actual transfer of ownership takes place, not earlier. Right? So that is a capital lease. Next, coming to conditional sale lease. What is this conditional sale lease? Under this kind of lease, the lessee may acquire the asset outright upon completion of the lease terms, provided that the buyout amount is paid at the end of the term. This is frequently preferred for businesses that intend to keep the asset. That means at that point of time, they do not have the entire upfront amount to pay and take the asset. So at that point of time, they take the asset on lease, but over a period of time, they manage to pay the entire amount and then they keep the asset for themselves. Then there is something called as a fair market value lease. Fair market value lease is also referred to as genuine lease, right? And now these type of leases, they allow the tenants to make small monthly payments in exchange for the opportunity to buy, upgrade, or return the equipment at the end of the lease period. So the fund, whatever funds are being paid, those are exempt from taxes. A company that sells an asset to a lessor and then immediately it leases it back. That is said to be sale and lease back arrangement. So what happens is this keeps the asset in use while giving the company instant cash. So, businesses that wish to manage cash flow and other necessary assets without the financial strain of outright purchases usually find leasing as a very attractive option due to the variety of choices and all the associated substantial benefits. Right. Next, let us look at finance leases. These finance leases, they offer long-term obligations and responsibilities similar to asset ownership. So let's delve deeper into when and why a finance lease might be the best option. See, what happens in a finance lease is the lessee essentially takes on the risks and benefits of owning the asset throughout a long-term lease. So mirroring ownership responsibilities, the lessee bears the responsibility for the asset's upkeep and related expenses, even though the lessor maintains the formal ownership. The ownership is still with the lessor. So this arrangement, it allows businesses to obtain necessary tools without using up all of their capital reserves. And it is frequently used for high value assets like, machinery, vehicles, and other equipment. Let us now look at some of the features of finance lease. In the first one, let us look at the risk and responsibility. In a finance lease, the lessee assumes comparable risk to that of an owner, such as insurance, depreciation, and maintenance. All that is taken care of by the lessee himself. Next characteristic feature is since purchasing high value assets outright, immediately paying, the entire amount might be very expensive for businesses. Finance leases are beneficial when acquiring vehicles or machinery. Okay. Next, ownership transfer options. So after the lease, usually the lessee can buy the asset at a set price, which frequently offers a substantial discount to its fair market value. Businesses can use this feature to purchase assets outright when the leasing period ends. Right? So these are some of the features of finance leases. Now let us look at the benefits. What are the benefits of finance leases? So finance leases allow businesses to access costly assets without requiring a sizable upfront investment, helping preserve cash flow for other operational needs. Okay. And then if we look at the financial perspective, financial leases enable organizations to manage financial ratios by keeping liabilities off their balance sheets and subject to the requirements of the accounting standards, right? And then looking at the usage. See, long-term lease agreements usually cover a large percentage of an asset's useful life, guaranteeing that the companies can use the machinery for an extended period. Finance leases offer a flexible finance option for companies that need high-value assets, but would instead not make sizable upfront commitments. So, by being aware of the nuances of leasing in financial services, businesses can maximize their asset management strategies and they can make well-informed financial decisions. On the other hand, an operating lease provides a short-term, more flexible option, right? So let us look at what are the key features of the operating lease and why it is ideal for businesses that are seeking flexibility without long-term commitments. So a financial contract known as an operating lease, it allows companies to temporarily rent assets like, cars or motor vehicles, trucks, without giving up ownership. So this type of lease is essentially beneficial to businesses seeking flexibility and lower costs. Right? Some of the characteristic features of operating lease are short-term rentals. See, operating leases ordinarily last for less than 75% of the asset's lifespan. So less time than the asset's useful life. So what this feature does is this feature allows businesses to use facilities or necessary equipment without making a long-term purchase. Next feature is flexibility. So because operating leases release the lessee from long-term commitments, the companies can adapt to shifting customer demands and market dynamics. So instead of locking up the money in buying one huge asset worth a lot of money, they can as well utilize that money uh, to cater to the changing customer needs and the market dynamics. So when technology develops or operational requirements change, now businesses can quickly upgrade or replace their equipment because they have anyway not paid the entire amount. They are only paying for whatever time period they have been using it. And then coming to maintenance management. In an operating lease, the lessor handles maintenance and repairs, which reduces the lessee's operational responsibility. So, see, the lessee does not have to pay the initial upfront cost of the asset. He does not have to pay for the maintenance. He also does not have to spend on any repairs also. So with this setup, companies can concentrate on their core competencies while minimizing unforeseen expenses which are linked to asset ownership. So if we have to look at some of the benefits of operating leases, the first one is lower monthly payments. Operating leases frequently have monthly payments that are easier to manage than traditional financing options. This affordability helps businesses maintain cash flow. Then absence of ownership risk. The lessee is not responsible for depreciation or any or major upkeep expenses because they do not own the asset. This lowers financial risk and has the potential to save an abundant amount of money, especially for companies that depend on, expensive, some organizations, manufacturing companies, for example. Some manufacturing companies are heavily dependent on large and expensive machinery. So for such companies, operating lease is a huge blessing. Coming to the tax benefit. Since operating lease payments are considered as operating expenses, what businesses can do is businesses can claim tax deductions, right? So therefore, operating leases are a very good option for businesses that are looking for flexibility, lower initial costs, and less risk associated with asset ownership. Coming to leveraged lease. So leveraged lease is a specialized financing arrangement in which the asset is leased by a lessor who partially finances the asset acquisition through borrowed funds, usually from some financial institution or bank. So there are three parties involved in this. First one is the lessor. So the company which is purchasing the asset or the leasing company, we can call it. Okay, the lessor, the lessee. Lessee is the person who's using that particular machinery, the user of that particular asset, and the lender. Lender is a financial institution or bank that has offered the loan. Financial structure. In a leveraged lease, loans finance the remaining cost asset balance. So the lessor contributes 20 to 40% of the asset's price. And this structure facilitates the acquisition of high value assets such as vehicles, aircraft, or machinery while allowing the lessor to minimize the capital outlay. So these leveraged leases, they are an efficient way to divide the financial risk among all the parties concerned. What is the benefit that the lessee has? The lessee gains access to the asset without making a sizable upfront commitment. And by retaining the asset, what is the benefit for the lessor? He retains the asset ownership, right? So the risk is reduced and he can recover the loan balance in the event of default. And further, because the loan is usually set up as a non-recourse loan, the lessor is not responsible for repayments if the lessee defaults. Right? So this is how all the parties, all the three parties concerned, all of them benefit. Next one is let us look at the benefits of leasing with leverage. Uh, this lease offers access to high value assets. So businesses that need flexibility can benefit largely from using expensive facilities or equipment without committing large sums of capital. That is the first benefit. Then coming to tax benefits. See, leveraged leases frequently provide lessors and lessee, both lessors as well as lessee, favorable tax treatment. The lessee or the renter, they can take advantage of depreciation tax shields, and they often claim the deduction of lease payments as operating expenses. And even the payment terms are flexible, are modifiable. These lease agreements, they can be tailored to each party's unique requirements, considering duration, payment plans, and options for buying the asset at the end of the lease. So leverage leasing is a beneficial financial strategy for companies that want to maximize cash flow without making any notable upfront investments, while while they're still retaining the access to the facilities or the equipment. So this kind of an arrangement is very conducive in industries such as construction, aviation, which frequently use short-term assets for leasing, right? So the sale and this is also one very big advantage that the parties have. The next type of lease or the next type of arrangement, financial arrangement that we would discuss is sale and lease back. Sale and lease back. So the sale and lease back strategy offers a unique opportunity for businesses that are aiming to increase their liquidity, right? So what exactly is a sale and lease back? A sale and lease back is a kind of financial agreement in which the owner of an asset, okay, owner of the asset sells it to a buyer and then he promptly leases it back from them, right? So what is happening with this tactic? The asset's original owner can release the capital while keeping the asset's operational advantages. Okay. So he's selling it and then again he's taking it back from them. So what are the key benefits of this sale and lease back arrangement? There is better cash movement. See, businesses can dramatically increase their cash flow by turning an illiquid asset into liquid capital. This quick cash, uh, it can be used for debt repayment, investments in business expansion, and can also be used for improved operational efficiency. And another benefit is the asset owners can release the capital that was previously tied up in ownership through sale and leaseback transactions. So this capital can be used to grow the company or to pursue their any other strategic goals if they have. And another interesting option is the sale and leaseback arrangement. Um, it it helps in the retained use of assets. For example, including the sellers who's now called the lessee. Uh, uh, it gives them the continuous use of asset. So what this does, this ensures the stability of business operations because switching to a new asset is not needed, it is unnecessary. Then stability and flexibility in financing. See, unlike traditional loans, sale and leaseback arrangements frequently offer a long-term financing option. They can lock in advantageous rental rates for extended periods, usually between 20 to 30 years. This long-term stability is beneficial in situations where interest rates are volatile. So, this kind of an arrangement provides stability in the sense every month the payments that are to be made, they are predetermined, they are fixed. And this kind of an arrangement also offers tax benefits. So in a sale and lease scenario, lease payments are tax deductible as operating costs. So this may reduce the seller's total tax obligations as it can substantially cut their taxable income. So you have seen that this kind of an arrangement, the sale and leaseback arrangement, has number of benefits. But where is it typically used? The sale and leaseback arrangements, they are widely used in manufacturing, retail, and healthcare industries, mainly involving high value assets like real estate and equipment. Um, for example, a manufacturing company may decide to sell its machinery to increase its liquidity while leasing the equipment to ensure its continued use. So I have an equipment, I sell it. The moment I sell it, I get the cash. My liquidity position increases, and as soon as I sell, I again take that equipment back on lease. So this is like a double advantage. I am getting cash, and I am also getting the continuous use of that particular equipment or machinery. So this sale and leaseback financing, it is an effective tool for companies that want to minimize the effects of traditional debt financing while maximizing liquidity, preserving operational continuity, and leveraging tax benefits. Now let us look at the overall advantages of lease financing, right? So lease financing is a very desirable alternative for companies that are wishing to acquire assets without incurring any huge costs. Okay. So some of the main advantages of lease financing are as follows. Reduced initial investment. So by leasing, what is happening? Companies are acquiring high value assets. Companies are acquiring high value assets like machinery or cars without making any sizable upfront capital investments. So this helps businesses allocate money to other operational needs and lessens the burden on cash flow. Business owners, another advantage is there is no dilution of ownership. So business owners do not have to give up their ownership stakes in their company because lease financing does not require any equity. If, take for example, instead of leasing the equipment, the business owners had to raise capital through equity. So what is happening? They are actually diluting their ownership. They are sharing a part of their ownership with somebody else in order to buy this equipment. But what is happening in lease financing? They are not raising any capital through equity because they don't need any lump sum amount. They only need to make monthly or yearly payments, which is like any other operating expense, right? And this is uh, uh, especially crucial for small to medium businesses that do not want to dilute their ownership, or they do not want to share their decision making authority with anyone else. This lease financing also offers tax benefits. So lease payments are frequently deductible from taxes as business expenses, which can result in significant tax savings. So depending on the lease structure, businesses can write off these expenses against their taxable income, improving their overall cash flow. Then coming to flexibility in asset replacement, leasing offers the freedom to swap out or upgrade assets with minimal inconvenience. So businesses that lease equipment can return or exchange it for newer models at the end of the lease term, thereby reducing the risk of obsolescence as technology is upgrading and advancing. This flexibility is imperative for businesses that are operating in fast paced industries where staying up to date with advancement is critical to their competitiveness. Because of these benefits, lease financing is a very popular choice for companies that want to improve their operational efficiency while effectively managing financial risks. Um, But these are all advantages of leasing that we talked about. But leasing also has certain limitations, certain challenges, or certain disadvantages. Let us first look at the disadvantages to the lessor. Okay, the person who is the actual owner of the asset, the lessor. So, what are the disadvantages to the lessor? In case of inflation, when there is inflation, this lease financing is an unprofitable arrangement to the lessor. See, because every year uh, the lessee receives a fixed amount of lease rental, which they cannot increase even if the cost of the asset increases also. So it is unprofitable during times of inflation. Whereas it is very profitable for the lessee, but unprofitable for the lessor. Okay. Then coming to double taxation. See, it is possible to be charged sales tax twice for the lessor. The first is when the asset is purchased, and the second when the asset is leased. Both the times they have to pay sales tax. Another disadvantage for the lessor is uh, the risk of damage to the asset. Since the ownership is not transferred, the lessee treats there is every possibility that the lessee treats the asset carelessly. And if it is not used properly, it is quite possible that it might not be in a usable condition after the primary lease period ends. Right? So these are some of the disadvantages associated with the lessor. Now, what are the disadvantages associated with the lessee? The first one is finance leases are non-cancelable, and lessees must pay lease rental even if they do not intend to use the asset. So, if the lease was entered for a period of 10 years or 20 years or whatever it is, even after some time, if they don't intend to use the machine, also they still will have to pay the lease because it is non-cancelable. And then this lease agreements, they might pay the lease for 10 years, 20 years, 30 years, or whatever it is. But in spite of that, they do not become the owner of the asset, right? And then lease financing is more expensive than other types of financing because the lessee is responsible for both the lease rental as well as the expenses associated with the asset ownership. So that is the disadvantage. And one more thing is, since the lessee is not the owner of the asset, he cannot include it in the balance sheet. And though he's paying monthly lease rental, though he's getting it repaired and maintained at regular intervals, but still, since the ownership is not transferred, he cannot show it in his balance sheet. Therefore, this results in an understatement of the lessee's assets. Right? So this is about leasing. Let us now look at what is the difference between hire purchasing and leasing. Usually, people tend to confuse hire purchasing with leasing. Let us look at the differences between two. So, hire purchasing and leasing are both methods of acquiring assets without the need for an upfront purchase. Right? Both of them, it is the same thing. You are purchasing the asset, but you don't have to pay the total cost of the asset initially. However, uh, they differ in terms of ownership, payment structure, and the transfer of risk. Hire purchasing involves acquiring an asset through a series of installment payments over a specified period. Right? Over a specified period, whereas leasing involves renting an asset from the owner for a specified period in exchange for periodic payments. So, what is hire purchasing? Hire purchasing is a financing arrangement where an individual or a business acquires an asset such as machinery or equipment without having to pay the full purchase price upfront. Instead, what they do is they make regular installment payments over some specified period, which typically could range for 6 months or 1 year or 2 years, 5 years also, right? So while the asset is in use, it is the property of the financing company or the seller only. But ownership is transferred to the purchaser only when all the installment payments have been done, including any interest charges also have been completed. So what this structure is, this structure allows businesses to obtain essential assets immediately without having to make any significant initial investment. All right. So how does the hire purchase system works? First, the hirer chooses the asset that he wishes to acquire, and he negotiates the terms of the hire purchase agreement with the seller, right? Then the hirer pays an initial deposit, or which is also called as down payment, which is usually some percentage of the total purchase price. Then the remaining purchase price, it is divided into equal installments to be paid over a specified period, whether it is monthly or quarterly. Usually it is monthly, but sometimes yes, quarterly also. And while the hirer makes these installment payments, he has the right to use the asset for his business or personal use. Coming to ownership of the asset, the ownership of the asset remains with the seller until all the final settlement is paid. Once all the installments, including any interest charges, are completed, ownership of the asset transfers to the hirer. Only after all these payments, all the installments have been paid, all the interest has been cleared, only then the transfer of ownership takes place. And throughout the hire purchase agreement, the hirer is legally obligated to make timely payments according to the terms of the agreement. So failure to make payments can result in repossession of the asset by the seller. Right? So this is what is hire purchasing, right? So if we have to differentiate between hire purchasing and leasing, hire purchasing involves acquiring an asset through a series of installment payments over a specified period, whereas leasing involves renting an asset from the owner, who is also called as the lessor, for a specified period in exchange for periodic payments. Right? Duration of hire purchases are usually longer, ranging from months to years, whereas lease durations are shorter and they're customizable. Whereas a hire purchase, it is not customizable. And in hire purchasing and leasing, in hire purchasing, the buyer gets the ownership of the asset, but only after paying all the installments. And in leasing, the owner remains, the transfer of ownership does not take place throughout the entire lease period. So these are some of the differences between hiring and hire purchase and leasing. Next, let us try to understand how leasing has grown in India. Let us try to understand the evolution of leasing in India. So leasing in India began in 1973 with the establishment of the first leasing company of India. So the leasing company, it has grown and adapted over time in order to meet the changing economic conditions and regulatory requirements. The first leasing company of India, the founders for this were Farooq Irani and A.C. Muttaya. Though this was the first one, but by 1980, many financial institutions and commercial banks, they started leasing. So this became more widespread. In fact, State Bank of India was the first commercial bank to set up its own subsidiary lease subsidiary in the year 1986. And it only became more and more popular by the day. And today, India has almost more than 1,500 leasing companies. Right? So that is the evolution of leasing in India. The next topic that we need to understand is what are the factors to consider when investing in lease financing, right? So what are the factors to be considered when investing in lease financing? So when considering lease financing as an investment option, uh, assessing various factors that can impact the financial decision is very crucial, right? So by carefully evaluating all these factors, businesses or companies, they can make informed choices that align with their needs and goals. So here are some of the key factors to consider. First one is financial considerations. So cost analysis, tax implications, and budgetary considerations are some of the financial considerations that need to be taken care of uh, uh, while one is investing in lease financing. So what is cost analysis? See, comparing the total cost of leasing versus purchasing. So you have to assess the lease payments, the interest rates, the fees, and the financial impact on the cost, cash flow and profitability, and only then take a decision. And then understanding the tax implications is also very, very important. Both the lessor as well as the lessee, they have to understand the tax deductions and benefits that are associated with leasing in order to optimize the tax advantages. Then coming to budgetary considerations. So, evaluating the impact of lease payments on monthly cash outflows, working capital, liquidity, and the potential risk, return on investment from leasing, all these things are very, very important, right? Just a sec. Right? After financial consideration, the next thing that needs to be considered is business needs and growth plans. Uh, Alignment with business objectives that needs to be studied. It has to be evaluated as to how lease financing supports the company's goals and fits into its overall business strategies. Then scalability and flexibility. So businesses need to assess the flexibility of lease agreements in order to adapt to the changing needs. The companies should consider upgrading or adding equipment during the lease term and also evaluate the ease of terminating or extending the lease agreement. How easy is it or how difficult is it either to extend the lease agreement or terminate the lease agreement? And then the impact of business operations and expansion. So companies should analyze the effect of lease financing on day-to-day operations, production capacity, efficiency, and also the ability to respond to market demands. So these are some of the points that need to be considered under business needs and growth plans. Next, coming to industry specific considerations. So under industry specific consideration, see there are specialized options for lease financing in India. So companies should explore these industry specific lease financing solutions tailored to specific sectors such as fleet management, direct equipment leasing, and all that. So understanding the benefits and challenges specific to that particular industry and evaluate the availability of specialized lessors or lease providers is very, very important. So what is applicable for a fleet management company that might not be applicable for some other production oriented company. So based on what is applicable for that particular industry, the company should check. The next one is maintenance and service requirements. So companies should evaluate the maintenance and service responsibilities under the lease. They have to assess the quality and availability of service support from lessors along with the leased assets reliability. Then coming to regulatory and compliance factors. See, understanding industry-specific regulations related to India's lease financing landscape is very, very important. Companies should ensure compliance with legal requirements and standards. They have to assess the potential impact of regulatory changes on lease agreements and factor in any compliance costs. Then coming to the risk assessment, this is very, very important. Companies should assess the risk. So risk management is very, very important. Companies should evaluate the asset value and the condition of the leased asset throughout the lease term. So factors such as maintenance requirements, potential obsolescence, unexpected expenses, or the need for an early replacement, all these things have to be considered. Next, risk assessment should also be done in the case of lessee-lessor relationship. So the lessor's reputation should be evaluated, his credibility, financial stability also should be evaluated. So they have to consider the track record of providing reliable assets, timely support, and adherence to contractual obligations. So you have to assess the risk of disruptions or complications from an if the lesser is unreliable, that could lead to a lot of disruptions or complications for the lessee. So it is better uh, that even before you entering into the agreement, you very clearly check what is the reputation and credibility and financial stability of the lessor, right? So these are the factors that need to be considered before entering into any kind of lease financing agreement, right? Just a second. Oh, yeah. Let us try to understand the financial evaluation of the lease. So any prospective lease that must be evaluated by both the lessor and the lessee. The lessee must determine whether leasing an asset will be less costly than buying it. Similarly, the lessor must decide whether or not the lease will provide a reasonable rate of return. Since leasing is an alternative to financing, what should be evaluated? The effect of lease decision from the point of view of lessee only should be evaluated. So as such, the decision of the lessee as to whether to take an equipment or lease essentially involves choosing between leasing and borrowing or buying. So if one option is leasing, the other option could either be borrowing that equipment or buying that equipment. So an economic evaluation of lease usually calls for comparison of the financial costs of the lease with the cost of borrowing necessary funds to provide the assets or to purchase the assets. So if the cost of the lease is found higher than the cost of borrowing, it would be better for the company to borrow and buy the asset. Whereas, if the cost of borrowing is higher than the cost of leasing, it is better for the company to take the asset on lease. So, if we have to look at the steps that are involved in financial evaluation, the first one is calculation of the loan payment schedule, right? Then calculation of saving from investment allowance, whatever tax saving you are making in form of investment allowance, that needs to be calculated. calculation of after-tax effect of cash salvage value, right? Calculation of the after-tax cost of owning the asset, calculation of after-tax cost of leasing, then calculation of the present value of the cost of owning and cost of leasing, and finally, comparing the present value of owning cost with the present value of leasing cost. All this would involve the financial evaluation of the leasing agreement. So a lessee has to do all these things. Only then the lessee can arrive at a decision of whether to take the equipment or lease, or whether to buy it or borrow it. So these are the steps involved in it, right? Next, coming to problems in lease financing. See, in spite of the increased importance, leasing industry is still facing a number of problems. First one is financial assistance. See, there is a very lukewarm response from commercial banking sector for financial assistance to leasing companies. And this is resulting in many leasing companies finding it difficult to support their fund-based operations. So banks and financial institutions, they're becoming increasingly selective and stringent in extending refinancing facilities, even against, lease receivables, despite the superior repayment performance of leasing companies as compared to most other borrowers. So, these companies which have recently gone to public are finding it difficult in getting their issues fully subscribed because of inadequate public support. At the same time, well-established leasing companies, they are finding their margins drastically reduced as a result of, large competition, which is brought about by a lot of new leasing companies have come into the market. So because of competition from all of them. And it is also feared that, the Indian leasing industry will not be able to recover from the present state of difficult funds position with them. The main reason behind it being competition, right? The next problem that we need to discuss is the sales tax, right? After the 46th Amendment to the Constitution, the various states have enacted a legislation that subjects even the lease rental to sales tax. Before that, lease agreements were not subject to sales tax because since it is not a sale, it would not attract any sales tax. But after the 46th Amendment to the Constitution, even lease rental is attracting sales tax. Now, this is inequitable as leased assets are already subject to sales tax at the time of purchase. So what is happening here? Twice that particular asset is being subject to sales tax. Once at the time of purchase and next at the time of lease. This problem is further compounded as the legislation in various states is not uniform. So, there is a concern that a transaction subject to sales tax in one state may be taxed once again in another state. And since the cost of effectiveness of leasing is significantly affected, there is this urgent need to provide relief to the industry from such inequitable taxation rules. Then the risk of obsolescence. See, so the modern techno-dynamic age, as we call it, right? It has given a very high scope for obsolescence, and that too at a very high rate. Okay, because of the technological improvements in production of machinery and process. So it will be beneficial for the lessee to have equipment on operating lease, wherein the risk of obsolescence is borne by the leasing company. At the same time, the leasing company will face a problem since it has to bear the capital loss in case of obsolescence. So either of the party is suffering. If not the lessee, then the lessor. Then the next one is cutthroat competition. So the immediate future of leasing companies in India is very, very bleak. Why? Because many companies entered in this field almost at the same time. A lot of companies are there in the market now. So this leads to cutthroat competition, and in the process, what happens is because there are too many competitors providing this lease financing, the lease rentals have come down drastically, and they have come down to uneconomic levels. It has been reported that the rate of interest is working out to be somewhere between 13 to 14%, which is very much below the average cost of capital. And as such, the survival of many of these companies is at stake. See, a buoyant market, it does not exist for all these companies in the segments they wish to operate. With rising competition, major players are diversifying their activities to other sectors. And furthermore, this leasing industry, it has been facing competition from the manufacturing sector. This segment has, been concentrating mostly in lease financing items where 100% depreciation write-off is available as of now. Then the next problem is lack of qualified personnel. So the success or failure of any business, it depends on the qualifications and experience of its personnel, and leasing business is also not an exception. So as the nature of leasing business is nothing but financing the capital equipments, the personnel working in these organizations must be well versed with all the procedures like appraisal, judging, integrity, and capability of the borrowed party. So in India, the concept of leasing business um, is a recent one, and naturally it is very difficult to get the right person to deal with the problems of this new business. So the leasing companies have to develop expertise and sophistication in handling the new types of businesses. Right. So this is about leasing. Next, we will look at venture capital financing. What is venture capital financing? Right. Venture capital is a form of private equity funding that is generally provided to startups and companies at the nascent stage, at the very initial stage. Venture capital is often offered to firms that show significant growth potential and revenue creation, thus generating potential high returns. So, how does the venture capital work? See, entities that are offering venture capital invest in a company until it attains a significant position and then exit the same. So, in an ideal scenario, investors infuse capital in a company for 2 years and they earn returns on it for the next 5 years. So, expected returns can be as high as 10 times of the invested capital. So, financial venture capital, it can be offered by venture capital firms, it can be offered by investment banks and other financial institutions, and it can also be offered by high net worth individuals who are also known as angel investors. So, venture capital firms create venture capital funds, a pool of money that is collected from other investors, companies, or funds. These firms also invest from their own funds in order to show commitment to their clients. So, who exactly are venture capitalists? Venture capitalists are those people who invest in the early stage companies that have a very promising future. A venture capitalist can be a sole investor or a group of investors who come together through investment firms. And why do these startups or these entrepreneurs they go to the venture capital funding, and when do they go? First one is at the stage of expansion. If a firm wants to expand its business, so opting for funding through the venture capitalist is a good option. Doing so, what it would does is it would encash their businesses financial and legal expertise, which is usually required whenever any business wants to expand. Next, coming to requirement of strong mentoring. See, venture capitalists usually bring in a lot of expertise, knowledge, and networking along with this capital investment. They can utilize their guidance to build their own network, promote their business and their direction, and ultimately they can make it reach bigger heights. And they could also, some firms, some startup owners might also approach venture capitalists at the time of completion. So, see, once a startup has gained a substantial reach, and most likely it has to face competition in the real market, then it is the correct time to go for venture capital funding for surviving and giving tough competition to others. Okay. Next, let us look at the types of venture capital. Venture capital can be categorized as per the stage in which it is being invested. Generally, it is of the following 6 types. The first one is called as the seed funding. So, as the name suggests, seed funding or seed capital is the capital that is invested to help entrepreneurs conduct initial activities for setting up a company. So, what are these initial activities? Product research, product development, market research, business plan creation. These are the initial activities. And to fund these activities, if an angel investor or a venture capitalist is giving money, then that is known as seed funding. Sometimes the seed funding may be provided by the owners themselves or their family members or friends also. So that is about seed funding. The next one is startup capital. So startup capital is often used interchangeably with seed funding, but there are minor differences. See, usually business owners they avail startup capital after they have completed the processes that involve seed funding. So it can be used to create a product prototype, or it can be used to hire some crucial employees, some crucial management personnel. And then the third one is called as the first stage funding. So first stage funding is provided to businesses that have a product in place. The product is already there, and then they want to start commercial manufacturing, sales, or marketing. That means they've moved beyond the product prototype level. The fourth type of funding is called as the expansion funding. So, as the name suggests, expansion capital is the fund that is required by a company in order to expand its operations. The funds can be used to tap new markets, it can be used to create new products, invest in new equipment and technology, or even acquire a new company also. Then the next one is called as late stage funding. So the late stage funding is offered to businesses that have already achieved success in commercial manufacturing and sales. Um, so the companies in this stage they usually have very good growth in revenue, but they do not show any profit. The last one is called bridge funding. Bridge funding is also known as mezzanine financing. This bridge funding helps a company to meet its short-term expenses necessary in order to create an initial public offering. So, coming up with an IPO requires for a lot of effort on the part of the organization. Lot of documentation is required. A lot of money is spent. So, if the venture capitalist helps a company to float its own IPO, then it is known as bridge funding. Let us look at some of the features of venture capital. So, some of the features of venture capital are: venture capital is particularly offered to small and medium sized businesses. It is not for large scale industries. See, large scale industries, well established industries, they can, as well raise capital or money through many other sources. So, venture capital is mainly for those small, micro, medium enterprises which cannot actually approach other financial institutions. So venture capital is mainly for them. Another characteristic feature of venture capital is the companies that are eligible for venture capital are usually those that offer high return, but also they have a very, very high risk, because the product or the new product or the new service might initially just be at the conception stage, or there might be just at the product research development stage. The next one is those who are offering to commercialize ideas. Like, those who are opting for venture capital usually seek investment to commercialize their idea of a product or of a service. And the venture capital firms or other investments or other investors, they may disinvest in a company after it shows promising turnover. So this disinvestment may be undertaken in order to infuse more capital or to generate profits. And one more feature about venture capital is a long-term investment. Whether the return, uh, uh, mostly the returns can be realized only after 5 to 10 years. Most venture capital investments are long-term investments only. Let us now look at some of the advantages and disadvantages of venture capital. Okay. Some of the advantages of venture capital are: first one, venture capital helps a business gain expertise. So one of the primary advantage of venture capital is that it helps new entrepreneurs gather business expertise. Those supplying venture capital have significant experience to help the owners in decision making, especially human resources and financial management. And the next one is business owners do not have to repay. So the entrepreneurs or business owners, they are not obliged to repay the invested sum. Even if the company fails, it will not be liable for repayment. Then the next one is it helps in making valuable connections, because venture capitalists have a lot of expertise and network. They can actually help these new startups to build connections, which could be of immense help to the startups in terms of marketing and promotion. The next one is venture capitalists also help to raise additional capital. See, venture capital investors, they seek to infuse more capital into a company by increasing its valuation. To do that, what they can do is they can bring in other investors at a later stage. And in some cases, what happens is the additional rounds of funding in the future, they're reserved by the investing entity itself. And another advantage associated with venture capital is it aids in upgrading technology. So venture capital can supply the necessary funding for small businesses in order to upgrade or integrate new technology, which can actually assist them to remain competitive. So these are some of the advantages associated with venture capital. Coming to the disadvantages. The disadvantages associated with venture capital are mm, the primary disadvantage is that the entrepreneurs or the startup owners, they have to give up a part of their ownership stake in their business. And many a times it may so happen that a company requires additional funding that is higher than the initial estimates. And what happens in such situations? The owners might end up losing their majority stake in the company, and along with that, they also lose the power to make decisions. So a startup uh, owner has an idea, wants to start a business of his own, but because he wants to invite funds through venture capital, he might ultimately become a minority stakeholder in that particular company. And another disadvantage is it gives rise to conflict of interests. Uh, so investors not only, they hold a controlling stake in the startup, but they also become members of the board, governing board. So as a result, what happens? Conflict of interest might arise between the owners and the investors, which could actually provide very problematic in the decision making process. And getting approval on something, or be making a particular decision could be a very, very time consuming process. So venture capital investors, they will have to conduct due diligence and assess the feasibility of a startup before going ahead with the investment. So this process can be very time consuming as it requires excessive market analysis and financial forecasting, which can delay the entire funding process. And the biggest challenge associated with venture capital is venture capital can be very, very, availing venture capital can be very, very challenging, uh, especially uh, for those who have no network. Approaching a venture capital firm or an investor can be very, very challenging. See, actually, venture capital was introduced in India in the late 1980s, especially after the economic liberalization. So, IFC, ICICI, and IDBI, these were some of the few organizations at that time that established venture capital funds, and they targeted large corporations. But the formalization of the Indian venture capital market, it started only after 1993. And these venture capitalists, they play a very pivotal role in the entrepreneurial ecosystem, serving as catalysts for innovation and growth. And these venture capitalists, they not only provide capital to these startup ventures, but they also offer valuable mentorship and networking opportunities, thus, accelerating their path to success. So, in a way, we can say that it is a symbiotic relationship where entrepreneurs gain access to the financial support and knowledge that is necessary to navigate the complexities of the business world, whereas the venture capitalists, they stand to benefit from the potential return on their investments. Right? Now let us try to understand the role of venture capitalists in entrepreneurship. So, venture capitalists, they play a multifaceted and an indispensable role in the world of entrepreneurship. Some key aspects of their involvement include critical funding, fostering innovation, and offering expertise and guidance. So, one of the most obvious and crucial roles that venture capitalists play in is providing funding to the startups and early stage companies. This financial injection is often the resource that allows entrepreneurs to develop their products, to hire talent or to scale up their operation. Venture capitalists invest their own capital or funds that is raised from investors, allocating it strategically to businesses that have a high growth potential. Next, venture capitalists are also at the forefront of driving innovation. So, by investing in novel and disruptive ideas, what they do is they incentivize entrepreneurs to push the boundaries of existing norms. They encourage them to do things differently, be more innovative and be more creative. So this innovation, it not only benefits the startups themselves, but they can also have far reaching effects on the entire industries, which leads to advancements that benefit the society as a whole. Then offering expertise and guidance. See, beyond the capital, venture capitalists bring a wealth of experience and industry specific knowledge to the table. They can often take active roles in the companies they invest in, and they serve as advisors or board members. Their guidance also helps entrepreneurs make informed decisions, avoid common pitfalls, and navigate the complex challenges of scaling a business sustainably. And if you have to uh, look at some of the emerging venture capital trends in India, uh, investing early is one such trend that is very obviously seen nowadays. So, investors are now significantly focusing their attention and resources on early stage startups that are displaying the strong enthusiasm for identifying and fostering potential opportunities within these nascent startup stage enterprises. This shift it underscores a growing recognition of the immense potential that is inherent in these young companies where novel and innovative ideas have their own origin. Right? Next, coming to corporate venture capital. See, well-established corporations, they are in the process of redefining their strategies by actively collaborating with startups to stimulate growth and drive innovation. So the notable upswing in corporate venture capital activities, they signify a strategic pivot as larger enterprises increasingly acknowledge the benefits of embracing external innovation. This emerging trend, it holds promising opportunities for startups seeking partnerships that can accelerate their expansion while affording established firms, novel viewpoints or increased adaptability. And another feature is influx of global capital. See, India's dynamic startup ecosystem, it has captured the interest of even international investors who are irresistibly drawn to the company's thriving startup environment, enticed by the potential for a wide range of investment prospects. So this influx of global capital, it not only broadens the spectrum of available funding sources, but it also raises the bar in terms of competition and industry benchmarks. So this is about venture capital. With this, I would end this session. The next session would again be on Saturday at the same time, 3 p.m. Thank you.